It was a fantastic day for the bulls in the stock market today with the S&P 500 up 2%. In fact, we had 90% of the components within the S&P 500 close in the green today. And we were really being led by some of the more aggressive areas like the mega cap tech-oriented players like your Nvidias and your Teslas of the world, kind of more speculative stuff, and therefore kind of a different feel to today's rally compared to other rallies that we've attempted recently that have been led by more defensive areas. So I think it was a pretty healthy risk-on type of a day. In fact, we only had one sector that closed lower today, and that was real estate. So we'll take a look at all of that and see what it means for our posture. And we did have some differences in our posture today compared to when I did the video on Tuesday. So you'll want to pay attention to that. And then we'll get into our trade application example where I wanted to focus on selling a bull put spread on a stock that just reported earnings within the last 24 hours and had a really nice reaction to that. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's May 26th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. You'll also be given the heads up as to what stocks in the S&P 500 are giving you overbought and oversold cluster signals at the bottom of those emails. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ. You probably have noticed that David and I have been trying to tweet out quite a bit more actively here recently, trying to make sure that we're training and teaching you as often as possible between our presentations and classes. So if you're not doing so already, would encourage you to follow us there at Twitter. And thank you to those of you that click like and retweet on these Market Outlook related tweets as well. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, my oh my, it was a beautiful day for the bulls. Finally, we've been waiting for one of these types of days, right? We finally had the rubber band stretch too far. I mean, how many weeks have we been talking about that? And talked about how last week was the 7th week in a row to the downside, and that throughout history there had only been 2 times where there was 8 weeks, and that we were exploring historically oversold conditions and just so many different statistics that were out there. So not a huge surprise to see us finally get a little bit of traction to the upside. So like to see it. Hopefully it continues for at least a little bit longer. We'll talk about that a little bit more as we head on over to the 4 grid later on. But before we get there, let's have a chat about how things broke down here in the S&P 500 today. Remember, this is the heat map of the S&P 500. And as I spent a lot of time discussing in my question and answer session for my premium members earlier today, the S&P 500 is a market cap weighted index. And so the sizes of these squares and rectangles that you see in front of you give you a sense as to how dominant those companies are, or how influential they are in the makeup of the overall S&P 500. So a stock like Apple, which is the largest publicly traded stock in the United States, is going to be much more influential than any other company out there. In fact, Apple itself, just one single company, is more important to the S&P 500 than all 3 of these sectors that you see down below here: utilities, real estate, and materials. You see that area that if you were to kind of chop that block off and then place it up here, Apple's rectangle would still be larger than that. So that is just an extraordinary thing to think about, that one single company is more influential on the S&P 500 than 3 entire sectors out there. But that is the way of things in the last decade or so. Of course, technology has been incredibly productive and successful, and it's scalable, right? A lot of these other areas like real estate and utilities oftentimes aren't very scalable. You can't just sprout up a real estate company here in the United States and then all of a sudden scale it over to Europe or China or something along those lines. whereas you can do that with Apple services and other things like that. So anyway, it's been interesting to watch the development of the sectors as the years have gone on. But these days, we are living in the land of the giants, and the giants are technology-oriented companies like Apple, which was up 2% today, Microsoft, which is up over 1% today, Alphabet was up over 2% today, Facebook was up 4% today, Amazon was up 4% today, and Tesla was one of the biggest movers in the market today, up 7%. So that had a huge influence, not only on the S&P 500, but also on the consumer discretionary sector that we'll talk about a little bit later on here as well. One other bright spot that I wanted to point out was Nvidia. It was up 5% here today on pretty aggressive volume. Some of you that follow that company close enough will know that they reported their earnings this morning, or actually it was late yesterday afternoon, and initially in the after hours session, Nvidia was trading lower. So it's usually a pretty good sign when you flush away all of the sellers that had initially showed up and then tack on an additional 5% on top of that once the normal market opens, like we saw with Nvidia here today. And we'll actually talk about that a bit later on tonight in the trade application example as well. But that was one of the true stars of the day because of how it developed, and it flushed away its initial losses and basically just pushed the bears aside, and the bulls just truly took over in that name. Still a lot of work to go with that one, just like a lot of tech stocks that have fallen in recent months, but at least it's a start, right? And that's all we can ask for after seeing 7 straight weeks of downward price action in the S&P 500. So there was a lot of green here. You didn't really have to look too hard to find it. JP Morgan, some of you saw me tweeting about that earlier this week. In fact, I think we talked about that on Tuesday. It continued higher yet again here today out of that blue zone on the dividend stair step chart, so is up another couple of percent. And then BlackRock, some of you also have seen me tweeting the dividend stair step chart out about BlackRock here in the last month or so, as its stock fell far enough to have a 3% yield once again, and it had a beautiful day here today, pushing up and out of that blue zone of the dividend stair step chart, up 4% here today. So great mover there for BlackRock. In terms of areas that struggled here today, there weren't a whole lot, but what I would say is that we had a little bit of red stress down below here, kind of in the utilities, real estate, and some consumer staples areas. Now, the bigger consumer staples actually were up today, so Walmart, Coca-Cola, Costco, Pepsi, Procter & Gamble, they were all up. But some of the smaller consumer staples like Kellogg and McCormick and Hormel, Hershey's, Smucker, they were down here today. Real estate, I think we'll see after a little bit that on a market cap weighted basis was the only sector that actually closed in the red today. But you kind of had a 50-50 mix within the utilities there. And then also you saw that big pharma kind of struggled on a relative basis today as well. Medtronic was a unique situation. They came out with earnings today. And by the way, some of you might have seen my retweet on Medtronic here today. They did raise their dividend. Remember, they are a dividend aristocrat company, but they raised their dividend another 8% here today, despite the ugly price action after reporting their earnings there. But another stock that was down today was AbbVie. Remember, I have just 2 bearish trades on in this presentation right now. One of them happens to be AbbVie. So at least for that perspective of this this trade application that I showed you here a week or so ago on that one, we're happy to see AbbVie down a little bit today in the face of just a violent move higher for the vast majority of stocks out there. So that one's kind of cooling off there a little bit. Also saw Merck cooling off a little bit. That one has been just quite the strange company to have moved up as nicely as it has in calendar year 2022. So it's almost like it's doing the opposite. While the market has been down for most of this year, Merck has had one of its best years in a while, and now today a big day up for the market, and participants chose to maybe take a little bit of profits there and direct it into some more speculative areas. So not a whole lot to chat about from a negative side of the equation, which is a little bit of a rarity. Kind of feels like the market finally took a collective sigh of relief here and sent some of those oversold stocks back higher once again. And I think we've got a chance that this can continue for a bit, right? Again, I kind of thought we would have this rally about a week and a half or 2 weeks ago. So it finally showed up. It just showed up late. But I do think that there's that possibility that we could have a decent chance to rally during the month of June. Beyond June, I am a little bit fearful of. My assumption and expectation continues to be that we'll catch a bounce in the short term, so that may have started already. In fact, it looks like it already has started this week. And then where it takes us is anybody's guess, but I, for one, do not expect the markets to go back up to new highs again. I think we will roll over before we get back to all-time highs, and we will continue to struggle on a relative basis here in the coming year or two. I hope I'm wrong about that, because my portfolios would appreciate it if I'm wrong about that personally. But we're kind of overdue for a more extended bear market, and it kind of seems like the seeds of that future potential bear market have already been sown to a degree with what we've seen thus far in 2022. So, I'm going to stay open-minded around that concept, and if I'm wrong, I'm wrong, and so be it. That happens regularly in this business, but that is at least how I'm kind of setting my expectations right now, that we have now started our snapback rally, but I do not personally believe that the snapback rally will be trend-changing, and I do not personally believe that we'll be back up to new all-time highs in the S&P 500, in coming months. So let's just all find that out together. Let's take a look at the main part of the platform now, and you can see it was quite a healthy day for the bulls. We were showing more positive closes than negative closes by the tune of 9-1. There was 90% of the stocks that closed in the green in the S&P 500 today, and only 10% of the stocks approximately that closed in the red. So it was an overwhelmingly bullish day there for once, right? We've seen a lot more of those overwhelming days this year, but most of those days have ended up being bearish days. And so it's nice to see that kind of aggressive trading in the opposite direction here, where maybe some value hunters are out there looking for opportunities, right? We talked about Intel as our trade application example on Tuesday's video, and how it had entered into the blue zone in the dividend stair-step chart for the first time in like 6 years. And then I showed you the monthly chart of Intel and was showing you how it was the first oversold monthly cluster on Intel since February of 2009, literally the bottoming month, or the bottom end of month for the 08-09 financial crisis. So a good example of extreme sell-off conditions in some cases. Now, as I was sharing the Intel information with my premium members in my class today, we did notice that if we go back to a monthly chart on Intel, the oversold cluster signal is now gone, because it's just rallied about 5 or 6% in just the last couple of days. And so it is a friendly reminder, just like I shared with you on that original tweet that we talked about on Tuesday, that I said there's a monthly cluster so far, but that could change by May 31st. And if this rally takes hold between now and the end of the month, which it looks like it is, then it's entirely possible that Intel will have had a monthly cluster in the middle of the month, but would not have actually formally closed with one because of the rally here at the end of the month. Anyway, good day there for the bulls, whether you're talking about Intel, whether you're talking about JP Morgan, whether you're talking about BlackRock, whether you're talking about Nvidia, whether you're talking about Tesla. It was a beautiful day there for the bulls. 90% of stocks closing higher here today in the S&P 500. Let's go ahead and pop on over here to the charts now and see what that means for our posture. As you can see, we've got some new information to discuss. With today's big rally, we do have some changes afoot, and positive changes, or at least bullish changes. Can't say positive because some of you might be quite bearish with your portfolio allocation right now, so you probably don't appreciate a day like today. But for the vast majority of listeners, I would have to imagine that more of your exposure in the market is to the long side of the market, especially since a lot of you have 401k plans and all that kind of stuff where it'd be awfully hard to have short positions. But nonetheless, to each their own, I guess, from that perspective. But for those of us that have a lot of long exposure, today was a glorious day. S&P 500 was up nearly 2%, just shy of it, 1.99% to formalize it there. You can see what that candle looks like. It was a nice looking candle. It wasn't necessarily a wild whipsaw-y day. In fact, you can see we have blue labels on all 4 of our charts up at the top, and that just basically tells us that today's range was actually smaller than the average true range, which is basically a way to look back and look at what the typical ranges have been and then average them out. So that's a little bit peculiar, because usually when you have a big move, whether it's up or down, chances are better than not that you will have an exaggerated daily range as well. But that just goes to show you how wild the trading has been in recent weeks and months, that despite a 2% up move for the S&P 500 today, you were still shy today at that 90-point range. It was still well within the average true range here in the last month or so. So kind of crazy to think about that. But nonetheless, we don't want to take anything away from the bulls. This was a beautiful day. We opened low and we closed relatively high. We had a little bit of a wick at the top of today's candle, but not much to discuss there. It wasn't a violent move off of the intraday highs. So I think we closed up there near the highs of the range, and that is a bullish feature. Now, specifically for the S&P 500, you will notice that we now have a different color background on the chart. It's light green. Yesterday it was dark pink. That is significant because it tells us that we have a new posture to discuss on the S&P 500. And that posture has changed as a result of the intermediate/green line pulling out of the lower reversal zone. Remember, the lower reversal zone is at 20, so we ended today at 22, and you can see that green line emerging just above that black line representing the lower reversal zone. So this is now what we refer to as a weekly bullish posture. It's not strongly bullish, but it is weekly bullish, and in order for us to eventually get to a strongly bullish posture, we need to oftentimes start with a weekly bullish posture, especially after a big sell-off like we've had. So while we don't know for certain whether this will lead to a truly bullish strongly bullish posture, at least we have the seeds out there, and now as long as we water them and give them some sunshine, hopefully we can see a little bit of movement here. Now, one of my fears is, in this particular case, because this rally that I've been expecting for the last couple of weeks took so long to unveil itself, in that time that it took, the moving average has pulled back. Remember, my initial thoughts is we were going to get the rally back here when we were getting these oversold cluster signals. And at that time, I was pointing out these 3 candles right there. And my hope was if we could get a rally started right there, and that was probably after, I don't know, 6 weeks of sell-offs instead of the 7 that we're dealing with right now. But if we could have gotten that rally started a little bit earlier, I was hopeful we could get back up to that falling moving average, which would coincide with the tops of those 3 candles. Well, the bad news is, because this rally took so long to develop and it finally started this week instead, that moving average has had time to fall even further. So after today's big rally, and remember, we're up about 6% off of the lows. We were talking about that in the class earlier today. We were just talking about a market that at its lows a week ago was down 20% from its highs, and now we're talking about a market that's only down about 13 or 14% from its highs. So this has been a pretty big move already in just 1 week's time. And you can see that we have now approached the underside of that 30-day moving average. But in this case, it does not coincide with the tops of these previous candles. Now, if we were to get our head up and bump the underside of that falling moving average, we're talking about the lower portion of these candles over here, which happens to also somewhat coincide with these candles from back here, the bottoms of these candles back in March and into mid-March, kind of that week there between March 8th and March 15th. So those are kind of the areas that I'm looking at myself. Is I want to see how we handle things once we get up to the moving average. It's possible that if this stalls out for another day or two, that moving average could come down some more. We might end up looking at that candle on the 17th as a possibility of being a double top formation with what we're dealing with right now. We don't want to get ahead of ourselves on that. We don't want to make assumptions because there is some good momentum behind the market right now. And if we're in a somewhat healthier market, we should be able to get up and through that particular area right there. In fact, this could end end up being seen as a little bit of a W formation or a double bottom right here as well. It's a little bit lopsided, but a lot of times once we get past the midpoint of that W, we could have a little bit of further room to the upside. So if we can do that, I want to see how we handle the underside of that falling 30-day moving average is one key area. And then my next level that I'm curious about will be up here at about 4170. At that level, we will be basically knocking our heads up on the underside of this prior support area. So many of you have heard of that concept in technical analysis that old support can become new resistance if we breach it. And so those are two areas that I think are achievable here with a good push of bullishness to the upside. And I would expect that that would probably happen relatively quickly, hoping that it can at least have some semblance of bullishness as we push into the June monthly options expiration date. But obviously news can change this. Earnings reports can change it. I know Costco was out after the bell tonight and stock was selling off a bit after their earnings announcement. So things change on a daily basis, but those are at least some levels that I'm looking at in the back of my mind based upon the technical analysis that I'm seeing here as well. So that's the good news. Back to a weekly bullish posture there on the S&P 500. Now, we actually had turned to a weekly bullish posture yesterday on the Dow Jones Industrial Average. So this was good to see a follow-through of that posture change today. So it firms it up even further. You can see that the Dow Jones has now taken back the leadership role from the Russell 2000. We've been talking about that tug of war here in the last month or so. Seems like one of them will have the baton for a few days and they'll pass it off to the other one. So at this moment in time, the intermediate reading on the Dow Jones mega cap blue chips is at 27, and that is slightly higher than the small cap Russell 2000 at 25. And you can see here we're even closer to the 30-day moving average there on the Dow Jones Industrial Average. But again, good to see the follow through here and good to see us maintain the weekly bullish posture that we already sported yesterday on the Dow. The Russell 2000 also had a weekly bullish posture. And by the way, the Dow was up 1.61% today. It was our laggard today, but remember that is fairly typical. Whenever we have a big up day, you would assume that the more aggressive indices, not the blue chips, would be leading the way, and that is how today shook out. Anyway, back down here to the Russell 2000, we were up 2.17%, so even better than the S&P 500 in that case. Yesterday, we already moved to a weekly bullish posture similar to the Dow. Today was a continuation of that, a confirmation that that indicator yesterday knew what it was doing to send it to that weekly bullish posture. So again, I'm going to keep my eye on how we handle things here with the downward moving 30-day moving average. In this case, that moving average is coincidental with kind of the support level that we saw here at the beginning of May. So that might be another excuse for selling or resistance if sellers are looking for it. So I'm going to keep my eye on that possibility as we move forward in the next week or so. But again, it's good to see. We've got the green line emerging out of that lower reversal zone. So that means that right now, 3 out of these 4 major U.S. equity indices are back to weekly bullish postures. However, they all still have a falling 30-day moving average that they are all down below. Remember, if we have any hope to have a legitimate bullish move this summer, we need to start spending time above the moving average. So that's going to be our first key resistance test. And we'll see if we can pass that test or if we fail it. But point is, we are going to approach those in all likelihood within the next week, so we'll all get to kind of learn that here together. Now, the Nasdaq is a little bit different than the other 3. The Nasdaq was actually the best performer today, up 2.68%. And judging by what I just got done sharing with you on the heat map, that should make sense, right? We saw Tesla was one of the best players in the market today. Nvidia was one of the best players in the market today. Obviously, 2 huge Nasdaq composite names there. So Nasdaq was up 2.68%, easily leading, to the upside here today. But the problem is, usually when we have these snapback reversion to the mean types of rallies, it's usually the stuff that's the junkiest that got sold off the hardest that bounces back the fastest as well. So we have to keep that in the back of our mind. Today was a great day for the Nasdaq Composite, but is partially due because of how poorly they've done up until today. So despite the really strong rally, where the Nasdaq was the best performer today, oddly enough, they're the only one that does not have a weekly bullish posture at this moment in time, according to the intermediate line on the market forecast technical indicator. So despite today's big move, the intermediate line reading remains at 15.66. It is rising, so that's the good sign, but it still needs to get up above 20 before we can get this color change on the chart and before we can officially say that we have a weekly bullish posture. So even if the market's up tomorrow, there's a chance that the Nasdaq might not go into the weekend with a bullish posture. There's a pretty decent chance that these other three will. But, we're still 5 points away to get out of that lower reversal zone there on the Nasdaq in terms of the intermediate line. So it's not exactly a layup that it'll happen tomorrow. There's a decent chance that it can. It's just that we would need a little bit of a bullish push again. It can't be just a sideways type of a day tomorrow to do that. Remember, tomorrow will be our final day going into the weekend. And of course, this is a holiday weekend. This will be Memorial Day here in the United States. And so the markets are not open on Monday. And of course, that means that market scholars and our premium classes will not be held on Monday either. Same goes for David's Saturday morning question and answer session. Whenever there's a weekend holiday, he does have the opportunity to take that Saturday morning class off. Normally, he is nice enough to teach our premium students bright and early on Saturday morning. So for those of you who have a job and a career and you're still in your working years and you keep on thinking to yourself, well, that Market Scholars premium education sure sounds good, but I wouldn't really get the full benefit out of it because I can't participate in it in the live classes. Now remember, you always have the ability to listen to all of the recordings of all 10 of our classes that we hold during the week. Those are available same day unless there's some sort of a weird technical difficulty. David teaches his question and answer session on Saturday mornings. I taught mine this morning. I have mine on Thursday mornings, but David's nice enough to actually teach members for a couple of hours on Saturday morning. So even all of you who have your 9 to 5 jobs during the week, you would have the opportunity to normally hang out with David and learn from him and get to know the other students and things like that in a live class on Saturday mornings. But with this being a holiday weekend, he's earned the right to have a day off. And boy, oh boy, he's been going around like crazy here lately. Some of you saw his pictures on Twitter. He had a kid that graduated high school last night, so lots of hoopla there, and congratulations to the Settle family for that. Anyway, here on the Nasdaq Composite, we do remain with our strongly bearish posture at this moment in time. So since we are getting closer to the weekend, I generally let David handle this since he usually has the Friday version of this presentation. But just to make sure, in case there are some folks that don't watch his presentations and only watch mine, I also wanted to point out that on the 1040 crossover method chart here, this is chart 4C for those of you that are following along at home, we do continue to have bearish longer term postures from this perspective, right? This has nothing to do with the market forecast technical indicator. It's another approach towards the markets. But if we were to apply a 10-week moving average versus a 40-week moving average, in all 4 of these charts cases, we do have what they call death crosses. Sounds pretty ominous, doesn't it? But that just simply means that in this case, the 10-week moving average is below the 40-week moving average and gives us a general sense from kind of a longer term perspective, not truly like years longer term, but several months longer term, that things are not all that rosy out there. This pullback that we've experienced in 2022 has been extreme. This has not just been a regular walk in the park type of a pullback. This has been an aggressive pullback, and it's been aggressive enough to actually have these death crosses show up here on the 10 versus 40 week moving averages. And remember, some of you might be familiar with that terminology of golden cross versus death cross, but you might apply it to daily candle charts. But remember, a 10-week moving average is the equivalent of a 50-day moving average, and a 40-week moving average is the equivalent of a 200-day moving average. So some of you might use this kind of approach on daily candle charts, and what you would do is use a 50 and a 200-day. This allows us to kind of look back in time a bit more without scrunching the charts up so much if we use weekly candles, but they are effectively one and the same. There might be slight differences when the crossovers take place, but they are effectively trying to tell you the same things. And so, one of the things this is telling us is that we are trading well below both the 50-day moving average and the 200-day moving average on most areas within the markets here, unless you happen to be lucky enough to be in, the energy sector or something like that. Let's step away from the charts here for a second, pop on over to the internet. I always like to get a chance to say thank you to those of you who help support this free YouTube video. It's your best opportunity to encourage us to continue to do these free YouTube videos for you because, of course, we don't make any money doing these videos. It's more of what we would refer to as a kind of a freemium business model where David and I as business owners do make money on the premium side of the equation, but we try to offer some free content out there occasionally to kind of give you at least a little taste of what we offer in our premium classes. And so that's what we're doing here with our market outlook videos. But remember, when you click like, not only are you helping support this presentation, and you're helping encourage us so that way we can justify in our heads the time that it takes to do these videos, which usually stretches out well beyond 3 hours worth of time all in. But it also helps you because remember, if you like this type of content, then Twitter and its algorithms will push more of that type of content to you. And so the more often you like the tweets from David and I, the greater the chance is that Twitter will send our tweets to your timeline. Obviously, you can always just come directly to David and I's timeline to read through it if you want as well. But to each their own. There are benefits to you beyond just helping be supportive of market scholars there as well. So anyway, remember that in order to help you find the tweet in question easier, we always pin our most recent tweet of our Market Outlook video up at the top of our timeline. So if you just come to twitter.com/Brandon Van Z, you will find that the most recent Market Outlook video that I've done is pinned up at the top to give it nice and easy for you to like it. You can also like it directly on our website for those of you that watch this video on our website. There's a little Twitter widget directly below the video that you'd be watching. On YouTube, we also include a link to this tweet in the description area to make it easy for those of you that watch these videos directly on YouTube. And then we also include a link to the tweet in question in the emails that we send out to you. So there's 4 different ways, but however of those approaches that you take, it all gets added up here in the total like there at the bottom. And as I always say, as long as we're getting up and over 100 likes, I'm happy to do these full-length videos for you. If we're under 100 likes, then I'm less motivated to spend the 3 hours during my day to do this free video. So do your best to help support us. We'll do our best to help support you in kind. So thank you to all 103 of you that clicked like for me last time around. Thank you to Boss and XO53 and Carl and Gerald and Ken, G, Dave's, Gerald's, or Jerry I should say, David, Roger, Richie, Lucius, Tom, HR, Duncan, Dale, Robbie Axelrod, I like that name by the way, Iakipa, Tom and Dave and SW, Kirk Michael, DGI and Options, Ruben, Mike, Margie, Steven, Vodacon, Ron, Rick, and the list goes on and on. I can't read them all, but I at least like to give you guys a shout out on occasion to let you know I see your likes coming through. I get a little notification post. You can see I get these little there's 6 little likes there waiting for me. So I see you, I appreciate you, and I encourage you to keep it up. And that way we can all have a smile on our face at the end of the day and justify the time that's spent on these videos. So thank you so much for your support. Let's come on over here, also see what else we've been working on here today. We had another great 3-hour class here today. Students let me off a little bit easier today. Usually we've been doing 3.5-hour question and answer sessions lately, but still had a great session of 3 hours nonetheless here for my Q&A class today. We had a conversation about interpreting equal weighting approaches versus market cap weighting approaches and some of the pros and cons, and how do you think about that, and how do you interpret chart 1H, and how do you interpret chart 1G. I also had a question about taking a look at micro or MCHP, I guess is the ticker symbol. Sometimes people will mention, Brandon, you need to start saying the ticker symbols when you're talking about these companies, otherwise we can't pull them up on our chart. So anyway, MCHP we looked at as a DGI candidate. We also took a look at FRT, a rare REIT, as a dividend growth investing candidate. Shared some interesting knowledge with the participants in the class today that is a little bit surprising to some, and how I think about REITs as potential DGI stocks and whether it's good, bad, or otherwise. So if you're curious about that conversation, check out the recording. I also got asked to look at Parker Hannifin as a dividend growth investing company, and then I got asked to review the today's option statistics area at the bottom of the option chain on Thinkorswim as well. So if any of that content is interesting to those of you who are premium members, remember you can just go up to the trading rooms area on our mega menu and click on it to get to today's recording that has now been posted. Let's also have a little bit of a chat here about the factor selector. Dividend yield remains number one. Now remember, this is 2 days old, so it does not include the big move that we saw today. So this is not real time. This is what I use in anticipation of my Wednesday morning factor-based swing trading class. I was actually just tweeting about that a second ago. We've been talking about how the momentum factor funds are a little bit diverging from one another as a result of their rebalancing policies, and how often or how not often in some cases those quote-unquote momentum factor funds are rebalancing. But anyway, dividend yield going into Wednesday morning was once again our leading factor. Some of you saw me tweet a moment ago that I had a small piece of good news in the fact that the dividend growth investing class that I teach on Tuesday morning, our portfolio went back in the green here with today's big market move to the upside. Now normally you might be thinking to yourself, are you kidding me? This guy's getting excited about just having positive results. And admittedly, it's not usually something you get excited about, but let's be honest. 2022 has been a year like no other. And so this has literally been the fourth worst start to the year in history. And so the fact that our dividend growth investing class is back in the positive territory where we are not sitting on losses, and in fact that is underselling it a bit, because if you were to add in all the dividends that would have been paid as well, it even adds to the return. But nonetheless, the fact that we are now back in the green in our Tuesday morning dividend growth investing portfolio year to date is saying something. So we can certainly verify what this graphic is telling us here, that dividend stocks are holding up reasonably well, at least compared to a lot of other areas out there, like your momentum and growth and low size and that sort of thing. Now, speaking of momentum, there was one impressive move here this week, and that was the momentum category. Momentum had been dead last for 4 weeks in a row, and we did burst up to the number 4 position. So at least we've got signs of life out of that more speculative area of the market. We've got work to do. It's not like a leader at this point, but at least it's not a dead last laggard. And momentum is one of the most speculative factors out there. It's basically chasing price, right? And the market's willingness to chase price. And for much of this year, the market has not been willing to chase price, and it's punished those who have tried it. But here over the last week or so, we have started to see a little bit of forgiveness around that concept of price momentum. That does mean that low size makes its way down to the bottom slot right there. So we'll see if that holds into next week after we've seen these big moves here today, but that's where things stood as of Tuesday night's closing information. All right, let's get back on track now with some more charts over on the Thinkorswim platform. Let's do some 12 grid analysis, starting with chart 5A. This is our asset class 12 grid, and a reminder that when the background colors of the charts are pink, we have a bearish posture using the market forecast technical indicator, specifically the intermediate line. When the background colors are green, that means that we have bullish posture using that same intermediate line. Now there's a couple different shadings, either light or dark, and so that plays a role to a degree as well. So technically there's 4 different possibilities: light green, light pink, dark pink. And we've got 3 out of the 4 possibilities here in front of us. So let's start with the one lone one, and that is dark green, and that is down here at the bottom with oil. And what that stands for is the fact that we have a strongly bullish posture on oil. All these other light green charts that we see above it are all what we would deem to be weakly bullish. And remember, on this 12 grid setup of 5A, you can right click on the chart and go to maximize sell, and that way you can kind of confirm with your own eyes what you're looking at down below with the market forecast technical indicator if you haven't memorized the background color switching philosophy yet. But here you can then see, okay, I get it. So oil is strongly bullish because we see the green line is well within the upper reversal zone in this particular case. In fact, this is a somewhat impressive day that we had here for oil, because we are now at our second highest close for oil, stretching back not just the 3 months of this chart, but years. The only other higher point was this oddball candle back here on March 8th, where we did close slightly higher. It was obviously well above it on an intraday basis as well, but the closing price that particular day was $85.43, and so we are now within $1 of the highest closing price on oil here all of a sudden. And remember, we talked about this here a couple of weeks ago, where I encouraged you not to give up on oil at this time, because there were some talk about people saying, okay, this is it. This is where oil rolls over, because they've been hearing the stuff on CNBC or what have you that says, hey, they're eventually going to go get the oil companies too, you know. And that's true. They eventually will, but it's just a matter of when that occurs, and we just haven't actually seen that yet. So wait to till for the market to tell you when that's going to occur. But this was still within the realm of normalcy. In other words, we had a low, we had a higher low, we had a higher low, and we had yet another higher low. So this was a pretty violent 2-day move, but it never did wreck that series of higher lows, and therefore the path of least resistance, and that's the whole reason I pointed that out to you at the time, is that because at the time there was a weekly bearish posture on the market forecast indicator, but I said, be careful with going overboard on that concept. I'm going to give oil the benefit of the doubt, because they've proven to me in the past that every time you've given them the benefit of the doubt, they've rewarded you. And so that's exactly what they've done once again. They have rewarded those of us that have stayed calm despite that 2-day move, and now we're all of a sudden knocking on the door of new highs here yet again. So oil has been the one steady eddy trend that you could have counted on this year to print money. That is saying something, because very few other places have given you that opportunity. Some years trend trading is easy, where you have, the general market flow is to the upside, and it's relatively easy to find stocks and sectors that are giving you an opportunity to make money to the upside by just grabbing the trend and just riding it. But this has not been one of those years. This has been a hard year for trend trading. So we are thankful for the 5 oil positions we have in my Monday top-down trend trading class account, along with an additional oil ETF. That has been a little bit of a bastion of safety to offset some of the losses we would have had in other areas there. So we are thanking our lucky stars for oil and oil-related trends this year, because it's been one of the only places you can actually get any benefit out of trend trading. The rest of these charts that are green are all in that light green color, telling us that we have some initial bullishness that we want to pay attention to. However, we do not have aggressive bullishness yet, and it's possible that that can happen, right? As I mentioned before, after we have big sell-offs, you need weekly bullish postures to start an eventual strongly bullish posture. But just because you get weekly bullish postures does not guarantee you'll eventually get a strongly bullish posture. So anyway, if any of these charts are going to get to strongly bullish posture, we're thankful that they're starting right now with weekly bullish postures. The one of these charts out of all of these that kind of stands out to me right now is high yield bonds. We talked about the junk bonds there on Tuesday as well, and I was pointing out on that day, so this was on this candle right here, on the video I did for you on Tuesday, I was saying that was a good sign that we are seeing risk appetite coming into the bond market a little bit more aggressively, because it is a little bit nerve-wracking that if you got a rally in the stock market, because remember, the market was down a little bit that day. The S&P 500 was down just a touch. It was that candle up there. See, it's listed in red. But I was saying on Tuesday that one of the positive elements of Tuesday's trading was the aggressive move higher in junk bonds. Typically, if there's stress in the financial system, junk bonds are not going to get an aggressive bid on that day. They are usually going to struggle. So that was a little bit of a sign. You don't ever bet the farm on some sort of an insight like that, but it was at least a way for our education to remind us that some of these seeds that we've been waiting for to bloom are starting to pop up, and these little things that we point out are leading to this bounce that we are now recognizing in the market. So this is a really healthy move. I mean, this is an aggressive move on junk bonds going straight up. So if there was really truly stress in the financial system, you'd like to think that this behavior would not be taking place in the junk bond world, because remember, these are the junkiest of corporations that issue the junk bonds. They don't want to issue junk bonds. They have to. They have to do it at high rates because they can't get better rates because their credit rating is terrible. So this is effectively saying that the worst credit areas of the bond market are doing extremely well in the market's eyes right now when it sends it up 3 days in a row to this degree, which is telling you that there is a sigh of relief out there. There is less stress in the system collectively than there was just a week ago. So that's a really good sign that we see there. And notice how much more aggressively junk bonds have gone up than these other two. U.S. government bonds, they basically just tracked a bit sideways here today, as did foreign bonds. So junk bonds were really an anomaly. They not only went up, they went up aggressively, and they closed at the high of their day for basically the third straight day. That is a really, really good sign for risk appetite, which is another reason why you can maybe feel like this bounce we're getting in the stock market can have a little bit of legs from this moment in time. Obviously not a guarantee there because every day changes, but is at least one more little notch there in the belt of the bulls to understand that junk bonds are aggressively rallying at this moment in time. You can also see that we're back above the moving averages on developed foreign stocks and also on preferred stocks. So they joined high yield bonds. Now we have those three charts that are trading above their moving averages there. And remember, a week ago, we really couldn't have a conversation like that. Most of these charts were below their moving averages. So we're starting to see some stabilization after having quite a bit of chaos earlier this spring and into the summer. And so, as you can see, foreign stocks did reasonably well today. They were up 1.1% in the developed foreign stock world and 1.56% in the emerging stock world. And by the way, remember we also talked about this on Tuesday. I was mentioning how the emerging markets were kind of being pushed around by the Chinese internet names. Some of you might have seen that today. Alibaba had one heck of a day. It was up 15%. They reported their earnings, and take a look at Alibaba surging above that moving average. Now, they did that back here as well, and it didn't hold, so no guarantees this one will either, but at least it's a good sign in general for the emerging markets, which is why EEM did outperform the developed foreign stocks here today. They both somewhat underperformed U.S. stocks, but all three of those categories now have those weekly bullish postures, and it does seem like the developed foreign stock has that opportunity here very quickly, as soon as tomorrow, to go to a strongly bullish posture because their intermediate line is at 48. So if they have another up move tomorrow, decent chance that ticks above 50, decent chance that this color will shift from light green to dark pink. I'm sorry, dark green, sorry. So it will join oil is another way of saying that. So when I'm back with you on Tuesday next week, pretty decent chance that oil will not be alone with the dark green background color. There's a pretty decent chance that at least the developed foreign stocks will be joining it at that time. Let's talk about some of the pink charts now, because oddly enough, it has been the pink charts that were leading the market earlier, and now that the market has kind of taken the baton, Now those are the ones that are selling off. So it's kind of interesting to watch that rotation take place. But earlier this year, the US dollar was one of the only places to find itself in the trend. Another one of those places was the 10-year Treasury yield. But in the last 2 weeks, we've seen a reversal of fortunes. Notice that the 10-year Treasury yield has sold off. We're now sitting at 2.75% on the 10-year Treasury yield. US dollar has sold off after having those overbought cluster signals. And by the way, we had an overbought cluster signal there on TNX as well that led to this sell-off. However, this one's not quite as clean because we also had these other two overbought cluster signals there as well. Whereas it is, obvious here on the dollar that had an impact. We had 2 clusters in a row, and that was the top of the dollar in this most recent move. So sometimes you can get those nice reversion to the mean types of moves, and we are seeing that right now play out with those areas. And so that's a more positive sign. Remember, if the 10-year Treasury yield can roll over, that will be supportive of those growth stocks that are in the Nasdaq. It will also be somewhat supportive of yield plays that are out there that are kind of competing with Treasury bonds at this moment in time. So both the US dollar and the 10-year Treasury yield both continue to have strongly bearish intermediate postures, which is a change of pace from most of what we've been talking about so far in 2022. All right, let's go ahead and now take a look here at our Sector 12 grid. This is chart 5C. As we've taken a look here, you can see we are starting to slowly but surely get more and more green charts to show up. That's what you want to see if you want to be bullish in the markets. Now we just have 3 remaining pink charts on the board, and that is communications up at the top, which was actually up nicely today. It was up 2.43%, but remember, they got absolutely annihilated a couple of days ago off of that Snapchat news. So they kind of have to bounce back more aggressively to the upside before a posture change because they went down to the downside more aggressively to start it. Down below here, we have real estate. Again, we had a long conversation in my question and answer session here today about real estate. So if you're interested in my deep and true thoughts on how real estate should represent or maybe not represent a chunk of your DGI portfolio, feel free to watch that recording if you're a premium member. But real estate was actually the only sector that was not up today. It was down 0.11%. Not a lot, but nonetheless noteworthy because today was such an aggressively bullish day. It's weird that we even had one sector that closed in the red today, but somehow real estate pulled that off. Now keep in mind that might be just a little bit of profit taking because real estate did have a nice 4-day move coming into today. So you can't necessarily blame people for taking a little bit of profits there if they were lucky enough to buy real estate off of that oversold cluster signal there a week ago. And then the other pink chart is discretionary. And so discretionary was actually our largest mover today. It was up 4.9%. Largely because of Tesla. And again, we had a long conversation in class today about market cap weighting versus equal weighting and how we think about those two things and interpret them. But one of the very specific examples that I brought up was Tesla's impact on discretionary in the form of XLY, whereas it has less of an impact on the equal weighted version of discretionary, which is ticker symbol RCD. So anyway, today was a very aggressive move higher in discretionary, but it's the same conversation I just mentioned a moment ago with communications. We've had very strong 2-day rallies in both of those sectors, but because both of them had aggressively sold off, you need more of a push higher before you get a shift in the posture. So, with discretionary, just to put that into perspective, even after today's rally and yesterday's big rally, you're still only at 11 on the intermediate reading. Remember, it has to get above 20 to get that light green background color. So even tomorrow, if we get a third straight awesome move in the discretionary stocks, it's still not a guarantee you go back to the bullish posture quite yet. But the good news is underneath the hood of discretionary, we are starting to see more positive movements. We saw Williams-Sonoma come out with a big move higher. And we also saw Dick's Sporting Goods with a very interesting day yesterday where Dick's Sporting Goods in the pre-market session was trading at $57 It is now trading at $84. Literally a day and a half later, it's gone from 57 in the pre-market to 84 at today's close. So it touched a 3% yield for a brief moment yesterday afternoon, but has now rallied so furiously that its yield is now back to only like 2.2 or 2.3%. So really wild trading there in some of those retailers. And so maybe, just maybe, we can kind of get back on track. But there's Tesla again, and kind of what Tesla looks like, because Tesla is going to dictate the price activity of XLY much more than something like Dick's Sporting Goods or Williams-Sonoma or Best Buy has even had a really strong 2-day rally. Remember, we actually have sold puts on Best Buy going still right now. We didn't intend to, but Best Buy sold off aggressively last week with Target, and therefore I had to roll the contracts, and so we're still in that trade, but now we're nicely profitable in that trade because Best Buy has actually had a very good week this week once they reported their own earnings. And all of our sold puts are in the driver's seat at this moment in time. And again, just to kind of stress that, I know I've been working with you guys on that, but remember, the most active trade that I have done in the last few months is a bullish trade. It is selling puts. And people are probably wondering repeatedly, why does he keep on doing this bullish trade? Clearly, we're in a more bearish market. And the reason is for days like today. When you are selling puts, which is a bullish technique, and you're doing it on aggressively bearish days, like I've hoped to have trained you guys to have done, you are getting more bang for your buck by getting more volatility on those days in the pricing component of the options. And therefore, when we have snapback days like today, we are really benefiting from that. So remember, I sold, as one example, on an index level, I sold puts on QQQ maybe about 2 or 3 weeks ago, and I sold the 260s, and now we're up here at 300 after just a couple of days. So anyway, I am happy to report that all of our sold puts seem to be in the driver's position right now, despite what has been a very tough stock market for those taking bullish trades. So anyway, discretionary still got work to do because Tesla has work to do. If Tesla and Amazon can make a big punch higher, then there's a chance that discretionary can join a lot of these other green charts. But if there's no participation to the upside from these levels out of Tesla and Amazon, there's not a very good chance that discretionary can kind of get it together, so to speak. So as we look at all of these charts here, again, we just have one dark green chart, and that is energy. Those are oil and gas stocks, and you can see they hit yet another high here today and are the best looking trend out of all of these charts. But it is at least noteworthy to mention that I had pointed this out on Tuesday as well. But remember, Tuesday I was saying keep an eye on utilities because they are now joining energy as being traded above their moving average. And you'll notice that today I can add an additional name there. Actually, I can technically add 2, actually 3. So there's a couple more that are almost hidden to the naked eye. The one that's more obvious is materials. Materials is now trading slightly above its moving average as well. But the 2 that I didn't notice until just the last second there are also financials and healthcare. And I can't really see with my naked eye that they're trading above the moving averages, but remember, if you know how to read and interpret the moving average colors, you will know what is the case and what is not. So notice that the colors of the moving averages on financials and healthcare changed to yellow. And what that means in this case, where the moving averages are still clearly going lower, is that price closed above those falling moving averages. So we now have one green moving average with the best looking chart of energy, and we have 4 yellow tipped moving averages here with utilities, materials, financials, and healthcare that are giving it the old college try, trying to put in a bullish push here. All right, let's go ahead and get into our trade application example today, and it comes from the technology space. And technology was up 2.4% today and now has a weekly bullish posture. And a big reason that technology was up 2.4% today was because of the security in question. So let me go ahead and pull up chart 3A. And I'm going to pull up Nvidia. It's fairly rare for me to be taking a trade in this presentation on the day that a company reports its earnings. But that was a kind of a unique situation here today with Nvidia. As I mentioned, technically they reported in yesterday's after-hours session. And initially, Nvidia was down pretty significantly. In fact, if I were to pull up, let's see if a 20-day, 10-minute will do it for us. It will. here's what I was referring to. When they reported their earnings yesterday after hours, Nvidia's stock price went down to $152. So it looked as though it was very much being panned, and people didn't want to have anything to do with Nvidia. They sold it off aggressively upon the initial release of earnings. But boy, oh boy, what a difference a day makes. Not only did Nvidia recover all of its losses, but it tacked on an additional $8 per share. So we're talking about a stock that within a 24-hour period went from 152 to 178. That's an aggressive $26 per share move that we just witnessed there on Nvidia in less than 24 hours. So kind of crazy to watch that take place. Back over here on a 3-month daily chart, you can see how that looks as well. We had a nice, bullish engulfing candle here with yesterday. We saw a continuation move here today where we closed near the highs of the day. You can see the background color of the chart switch from pink to blue, telling us that this near-term line is heading higher. And in fact, we had a little bit of a bullish near-term divergent signal as well. Notice that we had this trough in the blue line right here that I'm circling. We had a second trough that is obviously higher here just a few days after that. The two candles associated with that are on this candle right here and on this candle right here. So in other words, price went down at a time when the underlying indicator was showing an improvement. So that can maybe add to the enthusiasm around this trade as well. Now remember, the trade is already done, and what I did here in tonight's case was I sold a bull put spread. So not a naked put like I've done with so many other trades. This is a bull put spread, so that way I have an embedded hedge just in case this goes awry, because remember, we are still trading below a falling moving average. But my hope with this trade is that we get a continued market rally here for the next couple of weeks, and if that's the case, then our sold put portion of our put spread should be in good shape as we head towards the June monthly expiration period. So I sold, I believe, the 160s and I bought the 155s, and I think we got a credit. Maybe it was a 157.50. I'd have to double check. Remember, I send that information out to all of you via Telegram when I do the trade that are premium members of Market Scholar. So feel free to check the strikes and the prices I got out of the credit on the Telegram. But the point being, I'm pretty sure the 160 was the sold strike that I did, and that is effectively today's low. So if we can kind of maintain this support level at about 160 for the next few weeks while the markets have gotten a little bit more bullish, then that should be a trade that that can work out for us. And if it doesn't, if it rolls over, then in this case, that's why I have the long strike associated with it as a kind of a backup hedge embedded within that particular trade. Okay, so that's what I had for you here today. Hope you enjoyed the presentation. If you did, I ask one simple request out of you. Take 5 seconds out of your day and click like for me there on Twitter. As long as we're up and over 100 likes, I'll be happy to do another free video for you there on Tuesday, the next time I'm scheduled to do the video. If we're under 100 likes, then I'll probably just do a 15-minute version with no trade application example and only concentrating on the 4 major U.S. equity indices. So we'll let you guys vote through the likes, what you prefer. But that's it for me for the weekend. I hope you guys enjoy your holiday weekend. Good luck with the trading tomorrow, one last day before the holiday weekend, and we'll see you all next week at some point. Take care, everybody. Bye-bye.